All right, warm welcome everybody to a brand new week ahead. Now, we've got a very busy one ahead of us this week, guys. We've got a lot of economic data. There's also quite a few central bank policy decisions as well. So let's get stuck straight into it then. Let's focus on the main event for this week, which will, of course, be the FOMC policy decision coming up on Wednesday. Now, in terms of market expectations coming into this event, we can see here that the markets are fully pricing in a 25 basis point cut for the Fed for this meeting. Now, the reason why they're fully pricing this in is based on two things. Firstly, it's the change of language that we had from Fed Chair Powell, going back to the Jackson Hole Symposium, where he basically told us that yes, even though they think inflation might be going higher in the short term, they think it will come back down again, and they are right now more concerned about the labor market as they are when compared to the to inflation data. So they're more focused on labor as opposed to inflation, and that obviously gave us the first check mark towards a possible cut for September. The second reason why the markets are 100% priced for a cut already is because of the recent data itself, right? We had that one very bad jobs print 2 months ago. We had a similar bad NFP with the most recent data. We had a further downside revision in the jobs as well, and we had consumer sentiment rolling over as well. So there's been a couple of reasons why the markets have been so sure that we're going to get a cut for the September meeting. However, because of the veracity of the recent data that we've had on the labor side, the markets are not just fully pricing in a cut for September, they are also very close to fully pricing in a cut for the October and the December decisions for the FOMC as well. That's important for a little bit later. Now, what also makes this meeting for the FOMC a little bit more interesting for this particular month is that this is one of the months where we get the quarterly update of the Fed's projections. Now, that includes their projections for things where they see things like growth and the unemployment rate and inflation and obviously interest rates going into the next 3 years. Where do they see these things going in the next 3 years? Now, it's always handy when we go into these types of decisions to know what the Fed said they think is going to happen last time that we had these, and obviously based on the recent events, how we now see rates markets pricing these things, right? Is there a divergence? Because that'll tell us where the markets think the Fed will be pitching these dots. And obviously, if the Fed doesn't pitch the dots close enough to where the markets are currently expecting the dots to be, then that is where the possible volatility and opportunities for us can come in. Now, if we quickly take a look at what was priced going back to the June update, we know that the Fed back in June projected the federal funds rate to end the year at 3.9, which shows us one potential cut, and 2026 was expected to end at 3.6. Now, why is that important? It's important because the money markets right now, the Fed fund futures, are showing us a very, very different picture, right? If we take a look at what Fed fund futures are showing us by the end of this year, it's showing us 3 potential cuts instead of the one that was flagged, right? You can see here that the potential rate is sitting at 3.7 versus what the Fed projected at 3.9, right? So the market's pricing in those additional 2 cuts. And you can also see here that by the end of 2026, that is now sitting closer towards 3% versus the Fed's estimate or projection that was 3.6%, right? So what is money markets telling us right now? Money markets are telling us that, hey, based on all of the recent events, we think the Fed cuts rates 3 times this year, 2025, and 3 times next year for 2026, right? That is the baseline assumption going into this meeting, purely because of what money markets are pricing in. So knowing that, where could the possible surprise be if we do get a surprise? Well, obviously, a surprise would be a dot plot that either shows us less cuts than what the markets are currently pricing in, right? So showing us less cuts than the 3 for this year and the 3 for next year, or a dot plot that shows us even more cuts than what the markets are currently pricing in, right? So on the hawkish side, that means showing us maybe only 2 cuts for this year from the Fed, right? And potentially showing us, instead of 3, maybe showing us less than 3 cuts for next year. So if it shows us 2 cuts this year and 2 cuts next year, obviously that'll be a lot more hawkish than what the markets have already priced into rates markets. What about on the the dovish side? Now on the dovish side, that means showing us, potentially 3 cuts for this year, but then showing us more than, let's say, 4 cuts next year. So instead of seeing the year-end rate close to 3%, if they see the year-end rate closer to, let's say, 2.5% or even 2.7%, showing us that, hey, we think we're going to see a big series of cuts playing out throughout 2026. That'll obviously be a little bit more dovish, and that can get the markets going. If they see the rate, closer to, let's say, 2.4 or thereabouts, the market will start assuming that, hey, maybe these guys wants to front load cuts, meaning that if they start in the press conference talking about, the possibility of 50 basis point cuts as an option, then obviously that could be seen as a lot more dovish than what this market is currently priced in. Now, in terms of possible opportunities, let's focus on the US dollar first. For the dollar, I think positioning really matters right now. With markets already adequately short the dollar, and with the dollar index hanging very close around those very that strong level of support we've seen it bounce from so many times, I think the best potential for a very short-term trade would be a squeeze higher in the dollar if we got a hawkish tilt from the Fed. That doesn't mean that we can't short the dollar if we get a dovish outcome, right? That's also tradable. But because the markets are already short the dollar, and because there's been so much bad news trying to push the dollar lower recently and it just couldn't, I think for me it would have to be a very, very dovish tilt to make shorting the dollar from here attractive. I would much rather want to buy the dollar if it's a hawkish shift as opposed to selling the dollar if it's a dovish one. Now, in terms of weekly volatility expectations, take a look at this massive weekly range based on the implied volatility data. This is a huge range for the dollar index. But what I love about these things is look at where the options market thinks the high probability support and resistance comes in. Resistance right on top of that very key 98.70, 98.80 level where we've seen the dollar reject from so many times over the course of the last few months now or weeks now. And similarly, key support, not this recent one, but all the way down to that July low that we had around that 96.30, 96.40 level. So very key levels there to aim for to the up and to the downside if we do get a big surprise, whether that's a hawkish or a dovish one for the dollar. What about equities in terms of opportunities? Look, the opposite is true for equities compared to the dollar, right? They are currently, just like the dollar trading at lows, they are currently trading at all-time highs, which means stocks probably needs a lot of dovishness to want to extend higher much further from here. But, if we get a just as expected outcome, or if we get that garden variety dovish cut that just mirrors pricing, now that could underwhelm equities a little bit. But if you think about it this way, right, any type of downside that we get on an as expected outcome, the markets won't take long to realize, wait a minute, we've got solid growth, we've got inflation that's hot but not too hot, and we've got multiple cuts now confirmed. It would be really tough not to expect equities just to continue that upward grind eventually, even if there might be a little bit of a short-term disappointment in terms of the outcome. Conversely, if we get like a really hawkish tilt, showing those fewer cuts in the dots, or maybe a tougher talk from Powell about inflation, if we were to get that, that could invite some profit taking and some short-term wobbles lower for equities. But I think the asymmetry here is that there's limited juice to squeeze out of an as expected outcome and a bit more juice to squeeze in the short term if it's a hawkish outcome. In other words, if they come out hawkish, very, very short term, it's probably more sexy to short equities for a short term move lower. However, in the medium term, because cuts will still be confirmed, just lesser of them, and because growth is still solid and inflation is still okay, any type of massive dip will most likely be bought in terms of equities, right? So that is the type of play that I would much rather look for. I just have very little appetite to want to short equities right now. In terms of weekly implied volatility levels, we've got the low coming up very close to those recent lows around the 2nd of September and the end of August, which makes a lot of sense. And then above that, sky's the limit, but 67.75, close to that is the weekly implied volatility high. Now, what about gold? Gold, look, when it comes to gold, gold's been very resilient. Whether we had yields up or down, or the dollar up or down, that momentum is still very constructive and has been very constructive for gold. Having said that, though, we have really struggled to break above that very key level of 36.60 for gold. That doesn't mean that we can't break higher. It just means that when the market tries to, multiple attempts to break a couple of levels or to break a certain level, that does show us a lot of resilience there. So what does this mean? Look, I've got no appetite to just trade it outright here. Let's wait for the FOMC. But if we do get a hawkish surprise, that could knock it lower initially alongside equities. But, the buyers will most likely want to step in from lower levels. What could those lower levels be? We've got that spike high going back to, the 3rd of September, which comes up nicely alongside the weekly implied volatility low. If it's a super hawkish Fed, maybe we even drift lower and we see people only waiting to get back in from that 3,500 level. Bottom line is, I think short term, a hawkish Fed could give us a more sexy trade as a short-term play lower. Alternatively, though, if it is a dovish Fed, and let's say they do price in a lot more cuts next year than what the markets are currently expecting, I would not be surprised to see yet another all-time high for gold, right? So just because it struggled to break through 36.60 doesn't mean it will continue to do so. If the Fed is super, super dovish, we could easily see gold break through that level. And then obviously those round numbers will be in focus. 3,700, 3,750, 3,800, etc. So those will be key levels to watch to the up and to the downside for gold. And obviously depending on what type of outcome we get. Now, that is on the US FOMC side. There's also something else happening for the US that we do need to watch this week. And that comes up on Thursday. That will be the upcoming jobless claims print. Now, this particular print last week saw a pretty scary outcome, right? If we just quickly take a look at that, let me show you guys this. So this is what we saw last week. This was a bit of a warning sign for the labor market because throughout the past few, I don't just want to say months, but more recently, we've had that deteriorating NFP data. Now, throughout that entire time, as well as the entire last 4 years, if you think about it, let's just bring this chart a little bit further. Over the course of the last, 4 years, initial jobless claims haven't gone anywhere, right? We've been stuck between 250 and 200 to the downside. Now, what happened last week was the first new cycle high for initial claims data. Remember, this is that one constant that kept me kind of not too concerned about the labor market because it just didn't roll over, right? It's one of those things which just hasn't shown a lot of stress until potentially last week. Now, this was an ugly print. So with this type of ugly data point, why didn't the markets, start pricing in even more cuts? Why weren't the markets more concerned about the labor market seeing this type of data point? Well, one of the big challenges that we have with jobless claims data is that it is notoriously noisy, right? Meaning that we can see big upside or downside for that matter in 1 week, and then for that entire move to be reversed on the next week's print. So for example, back in October last year, we had that very scary number from 225 all the way up to 260. Back then, everybody reacted like we did last week, saying, oh shit, what's happening? Could this be the potential rollover for the labor market? And then the next week, we just pummeled lower again, saying, okay, no, it's a false start. We don't have to worry about that. So what's going to be very important for us this coming week is seeing how this thing trades, right? Do we see, or how this thing prints, do we see another push to the upside, which will be very bad and could weigh on the dollar in the short term, depending on what happens to the FOMC? Alternatively, if this thing starts to reverse aggressively back to the downside, that could ease some of those stress and that could provide some short-term upside for the dollar as well. So definitely something worth watching apart from the FOMC will be what happens to the claims data, because that one, it's either showing us that things are starting to roll over to towards the bad side, or it could just show us that, hey, it's another false start. Don't worry too much about it. Moving on. So that'll be a next key one, or another key one to watch for us in the week ahead. Now, the other data points that we get this week, we get the Canadian CPI data as well as the BOC decision. Now, the inflation numbers lands just the day before the BOC meets, which means that can provide some color as a backdrop for the meeting, but probably, the inflation data probably won't derail the main story, which is expectations for an interest rate cut. I mean, if we take a look at market expectations right now, we can see that expectations is for the headline CPI to tick up from 1.7 to 2%. Mostly a base effect story there. And you can see that for the more important measure, which is the average between CPI trim and CPI median, that is still expected to stay right on cue at 3.1%. So what does this mean for us? Look, on the surface, inflation is still, it's contained, but it's still too high to give the bank comfort, right? If you take a look at where we're trading, that 3%, that's their tolerance band. So we're currently sitting right at the max of their tolerance band. Does that really matter for this incoming meeting in terms of what the markets expect? Not really. Why? Because we've had huge job losses as well as GDP contracting sharply in the second quarter. The labor market right now, I think, is screaming a lot louder than the inflation data. So even if Tuesday's CPI comes in a touch hotter, the sense is that the BOC isn't going to hold back from cutting rates just because of one stubborn print. And again, why are markets so confident in a cut all of a sudden when we compare that to just a month ago? The main reason, just like in the US, it's all about the labor data right now. I mean, if you take a look at the recent data that we had, let's bring up the unemployment rate. Where do I have the unemployment rate? I'm pretty sure I had it here. But anyway, the unemployment rate right now for Canada is sitting at 7.1%. That's the highest that it's been since 2021. And if you take a look at what happened recently, this is the main focus. We've shed over 100,000 jobs. That's a contraction, right, in the last 2 months. So that is what the markets are focused on right now. They're saying that, yeah, okay, fine, inflation is a little bit hot here, but will that or should that stop the bank from cutting rates when they've shed 100K and unemployment is sitting at 7.1? Probably not, right? The markets think that the bank will still follow through and cut rates. Now, if we take a quick look at rate expectations, we can see the markets are sitting at about a 90% priced or probability and already priced for a cut. What does that mean for us in terms of tradability next week? Well, obviously, if we were to get a cut, the one that has been expected and the one that is, if you look at the way that the Canadian dollar has traded over the course of the last few weeks, this was the markets pricing in this cut, right? So I reckon the cut is already fully priced in. That means that if we do get a cut, that probably doesn't provide us with any real opportunity. What it also means is that if we, for whatever reason, do not get a cut from the BOC, if the bank decides to hold rates steady instead, that probably offers us the most attractive short-term play for the Canadian dollar. Because the markets, if you take a look at positioning data, the markets right now, even though we've seen a little bit of recovery, the markets are still very adequately short the Canadian dollar. And if you take a look at how the price action has played out, looking at the CAD index, which is basically just the CAD versus all of the majors, you can see that the markets are very short the CAD here. So if this bank decides to come out and they don't cut rates, that could see a nice pop to the upside for the Canadian dollar that we can look to take advantage of. And before you say, oh, but they should be cutting rates, this would not be the first time that the BOC disappoints market expectations. Remember, the BOC is not the Fed. They will surprise if they want to, and they have done it before. I'm not saying I'm looking for them to hold rates. Let's just be clear. I think they should cut rates, and I think they will cut rates. But there is a chance that they don't. And if they don't, then a long in the CAD will probably be the most attractive opportunity, just purely based on where positioning is sitting. Now, in terms of other data points, we also get some data coming out from the UK, jobs data, inflation data, and then obviously we have the Bank of England coming up on Thursday as well. The markets are not expecting a lot from that, right? In terms of the jobs data, look, the quality of the data continues to plague the ONS, right? That's been the case for the last 2 years. That means that, as usual, the markets will be looking at these with a big pinch of salt. Obviously, wage data will be watched given the recent comments about the labor market and about growth that we've heard. But it's unlikely that any massive any big trends will develop out of the jobs data. I think that would probably be a bit of a nothing burger going into this week, but because there is more focus on it, a huge surprise there can be market moving. On Wednesday, that also brings us to the inflation data, which this is really the major thing that the BOE is still focusing on right now. I think the Bank of England would like to cut rates more, to help out businesses, to help out consumers. But right now, inflation just doesn't allow them to cut as they might want to. Inflation is expected to, to stay roughly in line with the recent prints that we had. If you take a look at expectations, roughly in line with that. And as long as we get anything close to that, that doesn't provide the Bank of England with any reason to cut more aggressively, right? If we get anything close to these numbers, I mean, take a look at this chart here. If we get anything close to these numbers, there's just no reason for the Bank of England to want to change anything. So for the Bank of England itself, assuming we get data that's close to these levels, not expecting any fireworks from them. The Bank of England is expected to hold rates steady at 4%, likely another 7-2 vote split with Dhingra and Taylor potentially once again pushing for cuts, but unlikely, obviously, to sway other members in that direction as well. The interesting bit for this meeting will be the guidance. At the last meeting, the bank quietly dropped that line about policy needing to remain restrictive, which the markets obviously read as a first step towards them wanting to cut rates a little bit more, which wasn't the case based on the commentary that we heard afterwards. But this time around, the markets expect them to stick with the, that gradual and careful language, and basically just try and stay non-committal. Now, what about possible opportunities for this? I think if we will get an opportunity, it'll probably come down to the quantitative tightening adjustment. The markets are expecting that the bank will slow down the pace of their QT from 100 billion to 70 or 75 billion a year, shifting more sales into the shorter term maturities to basically try and calm down some of the jitters that we've had in bond markets, in gilt markets. Now, with the market still very short the pound, let me just show you this from a positioning point of view. With the market still where's the pound? Here we go. With the market still, stretched short the pound, I think the best case scenario for a possible trade would be the Bank of England dropping QT by a much larger amount. If they don't drop it from 100 to just 70 or 75, if they drop it to, let's say, 50 or even lower, that could ease quite a lot of stress on yields, and that could push yields lower. And even though that scenario where you have lower QT, lower yields, even though that would normally lead to a lower currency, remember in this case, things are a little bit different for the pound and yields. If we were to see yields going up and yields going down, that counterintuitively should actually be a positive for the pound due to the ongoing fiscal concerns that we had. So best case scenario for a trade would be a bigger than expected reduction in QT, potentially pushing yields lower as well as the pound higher. It's an unlikely outcome, but it's one that could potentially create an opportunity for us this week. Now, apart from that, the only other thing that's remotely excited to trade this week would be the Aussie jobs data. Now, this week's employment data, it will be a potentially important checkpoint for the RBA because the markets right now are expecting, just a modest gain here. Where is the employment data? Markets, I had this up earlier as 20K. It looks like Refinitiv might just have changed that. But expectations for this is to sit roughly at 20K after that big jump that we had in full-time employment the prior month, up to 60. The unemployment rate is seen steady at 4.2%. Now, again, the full-time, part-time breakdown will be very important for this print, because even though we had a lot of full-time up last time round, a lot of people felt that the big upside surprise we had in, the fact that a lot of the jobs that we had also came from the part-time side meant that it didn't show us a very strong underlying labor market, maybe just a strong seasonal impact that took place. So the big picture here, we know that the Australian job market has been cooling, but we know it's very far from collapsing. If you look at the recent job ads and the business surveys, all of them point to softer hiring ahead, while wage growth is also showing us easing as well. So how does this tie back to a possible opportunity? If you look at how markets are currently priced for the RBA, if you look at this from a rates pricing point of view, you can see the markets are sitting 50-50 odds for another cut this year, right? Sitting 50-50 odds for that November meeting. So if we were to get a massively hot print coming out from the jobs data, that probably sees the markets pricing in a much lower probability of a cut for the rest of this year. Now, that could be very good for the Aussie dollar in the short term, especially if you consider this from a positioning point of view, where the markets do remain fairly short the Aussie. Alternatively, because we're still sitting at that 50-50, if we were to get a really, really bad print coming out of the jobs market, that could easily see the markets ticking up that 52 to maybe up to a 60 or a 70% probability of a cut. And that could be really bad for the Aussie dollar. Now, between the two, even though the Aussie is still, stretched on the short side here, if you take a look at the recent price action, the Aussie has recovered a massive amount of its prior losses, right? Just looking at this last move from the 20th of August, the Aussie, looking at the index of the Australian dollar, the Aussie versus all of the majors, we've had a massive rush to the upside. So my preference for this would actually be to hope for a weaker than expected print. If we get that, that could add some short-term pressure back into the Aussie dollar. And we'll see how we can potentially look to trade that. We've got all of those other decisions coming up this week. We've got the policy decisions from the BOC, the Fed, from the Bank of England. If there's any very positive developments coming out for those ones, we could potentially look to pair the Aussie against them. Alternatively, we also have Kiwi GDP data coming up just ahead of the jobs data. If Kiwi GDP comes out really strong and Australian data comes out really weak, then that could potentially open up some opportunities to the downside for a pair like the Aussie Kiwi. We have seen a massive rush to the upside for this pair. We are currently testing some huge levels of resistance for the pair as well, around that 111.50 level. So if we were to see the right type of makeup here, good Kiwi data, bad Aussie data, that could potentially provide us an opportunity to trade that lower. Key support for this week would be 110.80. Let's just call it the 111 at the weekly implied volatility low, as well as that series of lows going back to the last few weeks. So that is all something that we can look for as possible opportunities in the week ahead. It's going to be a busy one. As always, I hope you guys will have a great one, and any questions, don't hesitate to let me know.